One of Canada's most respected apparel companies just got hit with a short report. Jehoshaphat Research recently released a short report on Gildan Activewear. This is the same firm that released a short report on goeasy, which ended up being one of the more accurate Canadian short reports we've seen in recent years. The core allegation against Gildan is that the company recent growth may not be as strong as it appears. Jehoshaphat argues that Gildan may be pulling sales forward through channel stuffing. In plain English, that means selling more product into distributors and customers than they can realistically sell through, making near-term revenue look better than the underlying demand. A big part of the report focuses on DSO, or Day Sales Outstanding. That measures how long it takes a company to collect cash after booking a sale. Jehoshaphat argues that Gildan's reported DSO looks much cleaner than the reality because of receivable factoring. Factoring is when a company sells its account receivable to a third party, usually a bank, in exchange for cash today. So Gildan reported roughly 78 days of DSO, but Jehoshaphat claims it should be closer to 129 days when adding back factored receivables. They also allege that Gildan has been giving distributors incentive to take more inventory, including longer payment terms, rebates, quarter-end incentive, and in some cases, allegedly 90 to 120 days payment terms. Now, to be fair, longer payment terms are not unheard of with large customers. The real question is whether this is normal business practice or whether too much product is being pushed into the channel ahead of real demand. Their concern is that if distributors are already sitting on too much inventory, future sales could slow sharply as inventory gets worked down. That creates a risk of revenue shortfall, especially the back half of 2026. They're also skeptical on the Hanes brand acquisition, arguing that Gildan is combining two challenge apparel businesses while taking on more leverage than it has historically carried. But the big caveat here is obvious. This is a short seller report. The author has a financial incentive for Gildan stock to fall. That does not mean that the report is wrong, but investors should treat it as one side of the argument. The DSO, factoring, payment terms, and distributor inventory questions are worth watching, but we'll need to see how the numbers actually play out. And that brings us to the bigger question. How should investors think about short reports in Canada?
Gildan is a good excuse to look back because Canada has had quite a few major short reports over the last 10 to 15 years. And if you feel like short sellers target Canadian companies more often than you'd expect, you're probably not imagining things. Canada has a lot of lower volume, lower float companies. Liquidity is thinner, the market is smaller, and regulations around short selling are arguably softer than they are in the United States. And that can make Canada an attractive hunting ground. But when short sellers have gone after some of the bigger Canadian names, the track record has been very mixed. We can start with Shopify. Citron Research, run by Andrew Left, released a short report on Shopify in 2017. The allegations were basically that Shopify's merchant base was questionable and that a huge percentage of merchants couldn't be accounted for. That ended up being a terrible long-term short thesis. Shopify has gone up massively since then. Now, Citron may have covered after the initial drop, but as a fundamental call, it was very wrong. Dollarama is another example. Spruce Point released a short report in 2018 arguing that margins were too good to be true. Traffic would decline, foreign currency hedging was propping up profits, and the company had run out of room to grow. That also did not age well. Dollarama has been one of the best performing Canadian companies since then. Canadian Tire is more nuanced. Spruce Point went after Canadian Tire in 2019. They argued that the company had questionable accounting, too much leverage, weak e-commerce growth, and that buybacks were being used as a distraction instead of deleveraging. Then COVID hit a few months later, so maybe they had the chance to close profitably, but several of their bear points actually became bull points during COVID. E-commerce accelerated, credit card activity picked up, and the business held up better than expected. That said, not every criticism was crazy. Growth is still slow, leverage is still something to watch, and the credit business has risk. Then you have Home Capital, which is one of the clearest cases where the short sellers were right. Mark Cahodas had been short Home Capital for years. The issue was around mortgage fraud, broker misconduct, and the company not being transparent enough with investors. The Ontario Securities Commission got involved, confidence collapsed, and the company faced a funding crisis. Eventually, Warren Buffett stepped in with capital to help restore confidence. So Cohodes was right on a lot of the substance. The company did have serious issues. The only thing you could say is the stock did not go to zero, partly because Buffett changed the outcome. Then Cohodes went after Exchange Income Corp, and that one went very differently. Exchange Income was a high yielding monthly dividend payer, and the short thesis was that the dividend was unsustainable. The argument was that once you accounted for all the capex needs to keep the planes flying and the factories running, there just wasn't enough cash left to fund the dividend. But Exchange Income fought back directly. They called the report bogus. They pulled their earnings reports forward and improved disclosure in that earnings report around maintenance capex versus growth capex. That short thesis did not play out. Exchange Income has done very well since then, especially when you factor in dividends. There's FaceDrive. Hindenburg released a report in 2020 during the COVID market mania. This was when anything tied to EVs, ESG, food delivery, or contact tracing could get a ridiculous valuation. FaceDrive had all of those buzzwords. It was a green ride-sharing company, food delivery, ESG branding, and then even a COVID contact tracing company. At one point, the company had a valuation of over $1 billion on a very tiny revenue base. Hindenburg argued the business was basically promotional, and this was one especially memorable one because my company was offered a large check to promote FaceDrive on YouTube. Thankfully, we passed. The short report didn't work right away. The stock kept going up for a while, but eventually reality caught up. The stock collapsed, regulators got involved, and the CEO eventually received a multi-year ban for running a public company. Then there's goeasy, which brings us back to Jehoshaphat. Jehoshaphat released a short report on goeasy in 2025. They argued that goeasy was understating credit stress, delaying delinquencies and charge-offs, and booking interest receivable that may not actually be collected. The report ended up being very accurate. The stock collapsed from its highs, and many of the credit issues Jehoshaphat flagged turned out to be much closer to reality than the market expected. And that's why the Gildan report is interesting. Jehoshaphat has credibility after goeasy. That does not mean they are automatically right on Gildan, but it does mean that investors probably shouldn't dismiss the report outright.
And I think that's the takeaway. Short reports are not all created equal. Some are promotional, some are exaggerated, some create panic and then end up being completely wrong. Shopify, Dollarama, and Exchange Income are all very good examples, but sometimes short sellers uncover real problems before the market catches on. Home Capital, FaceDrive, and goeasy are good examples. So a short report is not a verdict, it's a thesis. For Gildan, the key is whether the claims are measurable, and in this case, they likely are. Investors can watch DSOs, receivable factoring, payment terms, distributor inventory, organic growth, and whether revenues slows in the back half of 2026. If Jehoshaphat is right, it should eventually show up in the numbers. If they're wrong, Gildan should be able to keep growing, collect cash normally, and prove this is just normal distributor management. Short sellers can be wrong, they can be aggressive, and clearly have an incentive for the stock to fall. But every now and then, they find something real. With Gildan, we'll find out soon enough.